the 2009 to 2019 bull market run was so long, and towards the end, I think a lot of investors started to kind of second guess the opportunity of chasing those continued returns, because it's only natural. Every year, markets are going up, markets are going up. Hey, let's become more aggressive. Let's become more aggressive. Let's become more aggressive. That's a natural investor tendency. And we saw the first glimpse of why that's not necessarily the smart thing to do in that fourth quarter of 2018, kind of wrapping back up with what we talked about before. Because we saw how a diversified portfolio really does help, because although you may not have earned as much in 2019, or at least even in that first quarter of 2019 when the markets recovered and they had that quick V-shaped recovery, but you didn't lose as much in that fourth quarter of 2018, and a diversified portfolio beat out the S&P, even though it didn't earn as much. And that was, I think, a very good microcosm for this 20-year time period and moving forward, which is sometimes it's not about how much you earn, it's about how much you don't lose.
Exactly. I from the point of view, one thing I'd say about the allocate, diversify, rebalance conversation, I work for an investment manager. That's where I've been my whole career. But when you think about what Josh and Melissa do, roughly 90% of your experience as it relates to investing is your allocation. 10% is really what MFS does, which is our whole thing is our job is to take risk. We're looking to take the most responsible risk, and we're trying to help you all to win at the slowest speed possible, because we know that turbulence is inevitable. And so our job is to think about, okay, who are the winners that we want to own more of, and who are the losers that we want to be careful of. And if you want, Josh, I'll kind of share a couple observations there, and we can see if there's anything else you want to add. Is that okay?
Absolutely, yeah.
So I kind of feel, I don't know if this, I kind of feel like like you think about that chart we showed of markets expanding and then going sideways. I kind of feel like there's two cliffs, and there's a bridge between those two cliffs, and it's like a rope bridge, this narrow rope bridge. And I can't tell you how deep the ravine is, and I can't tell you how long that bridge is. And that's kind of the challenge that we have here today with talking about where we are. So what I'll say is, as it relates to the government, this is the biggest fiscal response we've ever seen to a crisis, bigger than 2008. The biggest monetary response we have ever seen as well. The virus, nobody knows. That's the challenge. Is this, are we in a situation where it's like Josh, you alluded to at the beginning of the call, that the cases are starting to slow down? Perhaps. Will we see cases pick up elsewhere in the world? We haven't really heard about Latin America. We're starting to hear about Tokyo. We haven't really heard about India yet. So it's probably going to be with us for a while. The bigger question, though, as it relates to what we do, is beyond the virus. Was the situation that we are investing into in 2019 perfect? And the reality is no. There has been a lot of leverage in the system. American companies, the ones that were winning, were doing their business really well, but the ones that weren't doing as well were borrowing a lot. So borrowing a lot of money, and instead of using that money to invest in their business, like our research and development, CapEx, things like that, companies were instead, and you're going to read more about this, doing share buybacks and using that to make their company appear to be pretty good, but in reality, a lot of that was engineered. And so it'll be interesting to see what happens when earnings come out for the first quarter. The market is a discount mechanism. It has typically a tendency to be forward-looking, but earnings are going to be pretty bad. And so then what happens? Do we see down